Hi, this is Robin with On the Pulse Investing here with some important notes on how to read our performance chart and to show you our invaluable risk management feature that is built into our system and how powerful it is in terms of keeping your money safe while aiming for a high rate of return. This chart represents our returns to date, the blue line being Pulse Investing's performance, and the red line indicates the performance of the S&P 500. Our goal is to always be above them, but also as far above them as we can get. I want to explain some important indicators at the bottom of this chart. First, we will look here at the gain-loss status. It simply represents the percentage in change for this particular day. Green represents a gain. Red would be a loss. So today, we gained 3.43% and the S&P gained 0.43%. The column to the right of that is the difference between the two. In other words, how much better is our core portfolio performing than the S&P on this day, which is 3 times better. To the right of that is the overall gain for Pulse and for the S&P since the activity began for this particular account, which was in July of 2012. Pulse has gained 37.99% and the S&P gained 19.46% during the same period in the last 10 months. So we are roughly twice the rate of the S&P. This is a good thing because we have a program where you can literally duplicate our exact trades. Now, the next column is the new feature we implemented for you on this chart to help you understand the risk versus reward calculations in our system. As we all learn in economics, higher returns entail taking higher risk. We measure ours so that you can see just what you are paying for in your risk versus reward with Pulse Investing. In our case, the risk is not linear to the return. If we have double the return, we will not experience double the risk. In this risk evaluation column, it shows that we are outperforming the S&P by 95.22%. In so doing, we are not also 95% in higher risk. We are only taking 1.5 in additional risk above the calculated risk in the S&P to achieve these high returns. That is amazing. It only costs us 1.5% in additional risk to add 95.22% in returns. These calculations are based mainly on the Sharpe ratio, which is a parameter used widely by many investment advisors. The 1% free risk is what we use to calculate our 1.5% additional risk. The 1% represents a return a person could expect on like a safe bank CD. Now we know there's no such thing as safe, but when one goes to a bank to get a CD, one would assume that it is a quote-unquote safe investment. As you can see, our additional risk is much, much lower than what you would expect for these kinds of returns. This is why we suggest to our followers in our trade duplication program to set their stop loss parameter at none, because our system handles these situations for you. Over here are some stochastics that describe the daily push of our account, the 3 indices, and the correlation between them. In other words, the agreement or the disagreement between them. Think of the activity as being like a gas pedal and how hard each category is pressing in an upward direction. So on a scale from 0 to 100, the Pulse account is pushing at a rate of 16%, which is not very hard today. The standard deviation in that portfolio is 42%, which means that not all the stocks are pushing in the same direction necessarily, or with the same agreement. The 3 indices, however, are pushing the pedal to the floor while the deviation is 0%, which means the disagreement between them is 0. So they agree in terms of the momentum. Below in the green box represents the various averages in the daily change and overall gain-loss. These are closely monitored as well. The first one is the average daily rate of return in the Pulse portfolio since the account became active on July 6, 2012. This 0.12% daily return fits within the Pulse Investing goal, which is to have an average daily return of at least 0.1%. This would yield us 36.5% annually or better. This is a very high goal, but so far, we've been able to achieve it. My grandmother always said, if you aim at nothing, you will surely hit it. The next row is the daily average since January 1 of this year, and you can see it's much better at 0.24%. If we could sustain this average all year, it would translate into huge returns. The third row represents the daily rate of return since the account had become all cash in February. All of these things are important to know in terms of steady performance and how to maintain it. Back to the left is the general status of the indices. So for today, it tells us what the 3 indices gained or lost, on the day in percentage and in points. We also measure the change in percentage of the volume today compared to yesterday, which is explained in more detail in our system overview video. All in all, the graph shows our successful returns visually, and we welcome you to be a part of it. There are other helpful videos you could watch that show how our program works and how to sign up, as well as an overview of how our SmartTech GV system actually chooses stocks. If you can manage these returns on your own, then you really don't need Pulse Investing. But if you are looking to achieve this kind of growth in your portfolio for the money you worked so hard to invest, you can find out about our program today at www.pulseinvesting.com. Also, this video was cut on May 10th, 2013, and we update our chart every Friday on the website. Please check on our progress to date, and any questions are welcome via the email address robin, R-O-B-I-N, @pulseinvesting.com.